This is Nightly Business Report with Bill Griffith and Sue Herrera.
Interest rates are still low by historical standards, and they remain just below the range of estimates of that level that would be neutral for the economy.
The Fed chief seems to signal a significant shift in the central bank's thinking, resulting in a powerful rally on Wall Street. Battle of the blue chips. Microsoft is close to overtaking Apple as the world's most valuable company, all the result of a remarkable reinvention. And pushing into pickups. Jeep adds fuel to its already hot brand with a truck designed to look like no other. Those stories and much more tonight on Nightly Business Report for this Wednesday, November the 28th. And we do bid you a good evening, everybody. Sue is off tonight. What a Wednesday, though. The Dow soared by more than 600 points, its biggest one-day gain in 8 months, and its second best day of the year. With today's rally, the Dow and the S&P have now erased their November declines after investors cheered those remarks from the head of the Federal Reserve about the pace of future interest rate hikes, which we will get to in a moment. Here are the closing numbers today, with the Dow advancing 617 points. We're back above 25,000. The Nasdaq added 208 points. That's a nearly 3% gain, and the S&P was up 61. Bob Pisani has more on today's Fed-driven rally from the New York Stock Exchange.
Stocks were in full-on rally mode today on the heels of Federal Reserve Chair Jay Powell's comments about interest rates and the economy. The Dow and the S&P have now gone positive for the month of November, and all three major averages notched their third straight day of gains. Big takeaway here, Fed Chair Powell signaled that current interest rates are near neutral and emphasized that the Fed is not on any preset policy path when it comes to hiking interest rates. He also reassured investors that the Fed does not see any dangerous excesses in the stock market today. Powell's remarks pushed stocks higher right across the board. Technology stocks got a boost led by software names and buzz over Microsoft becoming the world's most valuable company. Materials and industrials, which had taken a beating on trade concerns, slowing global growth, and a stronger dollar also outperformed today. And consumer discretionary names were sharply in the green, thanks not only to FANG stocks like Amazon and Netflix, their consumer discretionary, but also retailers like Ross Stores and Gap. The bottom line is this: the markets overreacted to Powell's comments back on October 3rd, and investors are waking up to the fact that the Fed remains flexible and continues to keep a close eye on the economic data. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
But what exactly did Jerome Powell say that sparked this rally and of this magnitude? Steve Leisman digs into that for us.
Federal Reserve Chairman Jerome Powell igniting a powerful market rally, saying the Fed is not on a preset course to raise rates, and the Fed is, quote, just below the range of neutral estimates. That's the rate that would neither slow nor speed up the economy.
Interest rates are still low by historical standards, and they remain just below the range of estimates of that level that would be neutral for the economy. That is, neither speeding up nor slowing down growth.
All that suggests the Fed has some, but not a whole lot more work to do. He added that rates remain low by historical standards and affirmed the Fed's plan to gradually raise rates, but with perhaps less certainty than he did in the past.
I liken it to, walking into a room full of furniture like this and suddenly the lights go out. So what do? You slow down and you maybe go a little bit less quickly and you feel your way more. That's just the thought, is that you feel your way more. So under uncertainty of this kind, you be careful. And I think that's what we've been doing with monetary policy for some time. We've been moving gradually in a way. It's a way of keeping those risks at bay.
Markets are pretty certain about how they felt about Powell's remarks. Stocks shot up, bond yields and the dollar shot down, and Powell maintained his generally upbeat view on the U.S. economy.
The unemployment rate is 3.7%, a 49-year low, and many other measures of labor market strength are at or near historic bests. Inflation is near our 2% target, and the economy is growing at an annual rate of about 3%, well above most estimates of its longer-run trend.
You could call this a relief rally, relief that the Fed is not hell-bent on raising rates no matter what the actual economic outlook, though acknowledgement that rates are going up from here. For Nightly Business Report, I'm Steve Leisman.
So do Mr. Powell's comments really reflect a shift in thinking at the central bank or not, and what does it all mean for the markets and the economy? Joining us tonight, Michael Farr, the president of the money management firm of Farr Miller in Washington. Michael, always good to see you. Thanks for joining us tonight.
Pleasure, Bill. Great to be here.
A lot of debate today whether, under the criticism of the president recently, did the Fed chair blink? Is this a game changer for the markets and the economy? What do you think?
You know, Bill, a little bit. I think Steve Leisman said it. You know, that what the market heard was that the Fed is not hell-bent on raising rates, that they are going to do what Jay Powell has said he was going to do all along, which is be data dependent. And I think that data dependency, walking through the dark room full of furniture, is reassuring to markets. Now,
does it have you rethinking your strategy? I don't know what you've been doing with the market lately here, but clearly today, Wall Street changed their thinking about the market. It seemed like a green light went on. What about for you?
You know, I continue to think probably that risk trade of the FANG stocks is something that's over with. I think the shift that we've seen to value is going to be with us a long time. This prospect of 2 to 2.5% growth next year and the following year make me think that we probably still need to focus more on balance sheets than the momentum stocks.
All right. So going into this speech, the feeling was we were definitely going to get a rate increase in December. Next year, the feeling has gone from 4 rate increases down to 2, maybe now 1. Does it matter to you how many they raise rates from here?
It matters to me that, yeah, a little bit, Bill, yes, because if we get 3 more, that takes us up to about a 3% Fed funds rate. That pushes the mortgage rate on a 30-year up around 6%. That could be too fast, so I'm encouraged that the Fed's going to be data dependent. You know, we haven't seen bull markets just die of old age. Most of them have been filled by an overly aggressive Fed, and that's what had scared Wall Street, and I think that's what has us feeling a little bit better tonight.
And with all of this said and done today, with this huge rally here, what do you expect for the rest of the year? Is this the Santa Claus rally upon us or not?
Art Cashin has been saying that you could look for the Santa Claus picture on milk cartons because it wasn't going to happen. He'd been MIA. I think this brightens the chances of a Santa Claus rally. I think that the comments from the Fed's statement when they actually go ahead and raise rates in mid-December will probably be along the same lines, and I think markets will take encouragement. And yes, I expect markets to finish higher on the year.
All right, very good. And Art Cashin, the longtime dean of the traders of the floor of the New York Stock Exchange.
You have to do it.
Great guy. Michael Farr of Farr Miller in Washington. Thank you, Michael. See you later.
Thanks, Bill. Thanks.
Elsewhere, economic growth remained pretty strong in the third quarter. This morning, we learned that gross domestic product, the broad measure of goods and services produced here in the U.S., grew at a 3.5% rate as expected. The report pointed to moderately stronger business spending and corporate profits, but a little bit weaker consumer spending. It was the second reading on the third quarter growth rate. But a new report out on the housing market shows that corner of the economy is not holding up as well, and it's especially soft among the home builders. Diana Olick explains.
Sales of newly built homes in October dropped to the lowest level in 2.5 years as potential buyers pulled back in this new normal of rising mortgage rates and sky-high prices.
I think the rapidity of the increase in housing costs, just given the level of price inflation on top of what's been a fairly quick move in mortgage rates, is making it difficult for the buyers to catch up.
The median price of a home sold during the month was down 3% compared to a year ago. That may be builders trying to respond to rising rates, or it may just be the mix of homes selling has shifted to lower-priced models. Today's buyers have new math to factor. Mortgage interest rates a full percentage point higher than they were a year ago. Builders have struggled to offer entry-level homes as their costs for land, labor, and materials rise.
The reality is land costs have been incredibly high, anything from permitting to development fees, and then labor has been a persistent challenge. Those things have really been the main drivers.
There now appears to be a glut of newly built homes for sale, the highest number of unsold units since 2009. This after 2 years of a housing shortage and still tight supply of existing homes for sale. Builders have been reporting slower traffic through their showrooms and have dropped their expectations for sales over the next 6 months. The only bright side to that high supply is that it could finally bring prices down a bit, a welcome chill as buyers and builders head into the slow winter months. For Nightly Business Report, I'm Diana Olick in Washington.
Time to take a look now at some of today's upgrades and downgrades. We begin with shares of Union Pacific, which were upgraded to buy from hold at Deutsche Bank. The analyst expects the railroad operator to post at least $3 billion in profit improvements. Price target now $175. The shares rose 3% to $151.98 today. Whirlpool, though, was downgraded to neutral from outperform at Credit Suisse, with the analyst saying that the solid pricing environment for appliances appears to be reflected in Whirlpool's stock price already. That price target now $125. Whirlpool shares rose, though, along with the rest of the market, to $126.22. And American Airlines was given a positive rating and new coverage at Susquehanna. The analyst says the airline has strengthened its overall network. Price target $47. Shares rose more than 1.5% today to $38.94. Still ahead, a 1-2 punch for the nation's soybean farmers. Investigators are now looking at possible maintenance mistakes that may have played a role in that fatal Lion Air jet crash last month. Initial findings now point to possible errors by mechanics who worked on a malfunctioning sensor just before that flight. The report says the plane was somehow approved for use even though its flight control system experienced issues on past trips. The findings at this point would seem to exonerate the jet's manufacturer, Boeing, and its shares rose as a result by 4.5% in today's trade. Microsoft, wow, it's close to overtaking the most valuable company crown from Apple, a position that the software giant held years ago. At times this week, Microsoft's market valuation briefly exceeded Apple's, but at the close today, it was just below. Microsoft's market cap came in at $852 billion. You can see it's about $6 billion lower than Apple's. But the climb does underscore renewed investor faith in Microsoft after a long stretch of time when the stock was essentially considered dead money. But that changed when Satya Nadella became CEO back in 2014. He has pushed the company in new directions with a focus on the cloud and newer technologies like augmented reality. And with Microsoft now a business model for reinventing itself, are there other companies out there that could do the same? David Dietz is back with us. He's president and chief investment strategist at Point View Wealth Management. Good to see you again. Welcome back.
Thank you, Bill.
First of all, a breathtaking reinvention for Microsoft, right?
Yeah, absolutely. I mean, it was a monopolist, but the legacy server client model has started to show its age as users transition to mobile, to the cloud. It had kind of lost its way. There's a change in management. Nadella reinvigorated with a culture of innovation, collaboration, moved with the Azure to the cloud, and came up with this Office 365, which allows you to keep your data on site or up in the cloud as you wish.
Right. So we have to ask ourselves, okay, who else could do the same thing? Who are you looking at as possible reinvention candidates right now?
That is the holy grail, Bill. And we've got really three candidates here: IBM, General Electric, and Procter & Gamble. I'm going to start with General Electric because I think they have the best opportunity to make the big home run. Like Microsoft, they've got a new leader here, Larry Culp, who had a stellar record at Danaher, so he's going to reinvigorate. They already have world-class divisions, aviation, healthcare. So it's just a question, in our view, of kind of winnowing out some of the dead wood and allowing investors to highlight there. And it's, of course, it's just 1/12 the price of Microsoft, either price of sales in terms of market cap. Right. That's one we're looking at.
All right. IBM, Ginny Rometty has been trying to turn this company around for a number of years now.
It's in technology. They've just made a great acquisition with Red Hat, which will catapult them further into the cloud. Here's the problem. Gina Rometty has been CEO longer than Nadella has been. She was there in 2012. She told us in 2015 they're going to make $20 a share. Now they're at about $6 a share. So she kind of owns the dismal performance. So is she the right person to make the turnaround?
Okay. Procter & Gamble, quickly, they've been subject of a lot of shareholder revolts and things, trying to get them to reinvent themselves as well. Can they do it?
Well, they've already made a great start. They're at about 101 brands. They've got down to 65. 21 are 1 billion or more, and they are leveraging their huge scale, their huge purchasing power, but at the same time allowing various divisions to get closer to the consumer. Interestingly, they've allowed Nelson Peltz to come on the board about a year ago. He's also putting their feet to the fire. So we see them, too, as a great hold for investors looking for a turnaround in leading the consumer product space.
Those activist shareholders having a big role these days. David Dietz, good to see you again.
Thank you, Bill.
David's with Point View Wealth Management. Elsewhere, Tiffany loses its luster, and that's where we begin tonight's market focus. The luxury jeweler reported disappointing revenue and same-store sales. They cited weak demand from foreign tourists, especially from China, who spent less in the U.S. and in Hong Kong, and shares fell nearly 12% to 92.54. That's our worst day since 2015. J.M. Smucker missed Wall Street earnings and revenue estimates as well and cut its profit and sales forecast for the year. The company cited an increase in competition, which it says forced it to cut prices on things like Folgers coffee and Jif peanut butter. And shares dropped by 7% today on an otherwise big up day, now to 101.28. Dick's Sporting Goods reported a drop in revenue from a year ago and its fifth straight quarterly decline in same-store sales. The retailer said it faced challenges selling electronic devices, and it's struggling with its gun business as well. Now, despite the decline, the company did raise its earnings outlook, and the stock rose more than 2.5% to $37.26. Meanwhile, Chico's reported disappointing earnings and revenue. That retailer placed the blame for its weak sales directly at the Chico's brand itself. The CEO says the store has plans to shift its strategy and change its product offerings. It also announced the departure of its brand president. Small cap stock plummeted by 34% today to $4.79. And tobacco giant Altria is reportedly in talks to take a significant minority stake in e-cigarette maker Juul. According to the Wall Street Journal, a deal is not imminent. Juul, which of course launched in 2015, is now valued at around $15 billion. It has quickly become a leader in the e-cigarette market. Shares of Altria, used to be Philip Morris, closed 2% higher today to $54.95. And now to trade and some harsh words from the CEO of Deere. He says the trade war could have a lasting impact on America's farmers and the agriculture sector, something his company is seeing firsthand.
In the longer term, the issue that we worry the most about is that as China buys soybeans from Brazil or whoever, structurally, countries like Brazil will be able to bring more land into production quicker. And as a result of doing that, we'll end up with an oversupply for a longer period of time, which will mean that the pain that the U.S. farmer is feeling now will go on for a much longer period of time, much like the grain embargo in the 80s.
And for America's soybean farmers, it's not just trade that they're dealing with. Wouldn't you know, they also have bad weather and rotting crops as a result. Aditi Roy is in Ville Platte, Louisiana.
This spring, Richard Fontenot planted 1,700 acres of soybeans on his farm. But come harvest time, rain pounded his crops for days on end, damaging much of his crop. Nearby grain elevators, already filled up to near capacity because of the Chinese tariffs on U.S. soybeans, wouldn't accept his soybeans because they were too damaged.
It's always emotional. It's an emotional roller coaster.
In the end, the fourth-generation farmer was forced to let 60% of his crop rot in the field.
If the commercial elevators upriver had no room to store it, we could harvest it, but no place to dump the trucks. So we had to leave it out in the field.
But bad weather is only one of the problems facing soybean farmers across the U.S. U.S. soybean farmers usually export about a quarter of their crop to China, and that market has virtually disappeared. The glut has pushed prices down from about $9.84 a bushel during planting season to $8.60 at harvest.
For us, in this operation, this sale, we probably have about $8.50, $8.25 a bushel tied into making the crop. And after discounts this year, we're going to be selling it for about $6.50, $6.25 a bushel.
As a result, Fontenot will lose about $300,000 this year. and he can't store his crop because the grain elevators are full and his crop too damaged.
To make matters even worse, many farmers can't even access the Trump administration's aid to ease the tariff impact because they're not eligible for those dollars if their crops are still in the ground.
We had no exports because of the effects of some negotiations. Those effects carried all the way back into the field.
To ease the loss, Louisiana Representative Ralph Abraham just introduced a bill which would allow farmers with unharvested crop to access trade aid. Fontenot says that's a good idea, but argues for long-standing relief, farmers need enduring trade relationships.
We have to do things as a country and as a nation to protect things and maintain us being sustainable for years to come. And trade agreements are one of those things.
It's not just farmers here in the South who are hurting. A new Fed report shows that farm bankruptcies are also on the rise in the upper Midwest. For Nightly Business Report, I'm Aditi Roy, Ville Platte, Louisiana.
And still ahead, Jeep drives into new territory.
Jeep, which has been red hot with SUVs, is getting into the pickup business. What does the new Jeep pickup look like? I'm Phil LeBeau in Los Angeles. We'll show you coming up on Nightly Business Report.
We have an update now to a story that we have been following. A former Insys executive has now pled guilty as part of an opioid investigation. The drug maker's former vice president of sales is the highest level executive to admit to wrongdoing in a scheme to bribe doctors to prescribe the powerful medications. In pleading guilty, he entered into a deal to cooperate with prosecutors, and he could become a key witness in an upcoming trial that includes the company's founder. Well, with pickup sales surging, more auto brands want to sell new trucks. The latest is Jeep. But Jeep's new vehicle is not exactly your typical looking pickup. Phil LeBeau has more.
Jeep, one of the hottest brands in the U.S., is heating up the battle to win over pickup buyers. The new Jeep Gladiator, which looks like an SUV with a short pickup bed, has a decidedly different appearance, and that's by design.
You got 42 brands and you got 300 nameplates out there, and if you don't stand for something, you stand for nothing, and you're going to compete as a commodity. You can't do that. We have to have a positioning. The brand has to stand out, and the vehicle lines within that brand have to stand out, and we think this absolutely breaks the mold.
Jeep's resurgence in America is due in large part to the vision of former CEO Sergio Marchionne, who envisioned a world with more people wanting SUVs. That helped spark a boom in Jeep sales over the last decade. Now the company is trying to extend the Jeep brand with a pickup truck geared for a different type of pickup buyer.
The lifestyle buyer is that nice to have truck buyer. It's not going to use it for the day-to-day utility, doesn't need it for employment or anything like that. Somebody who likes to have a bed, that might like to tow things recreationally, but is using it more to kind of do things that they'd like to do instead of those things they need to do.
While Americans may love pickup trucks, they are also incredibly brand loyal, which is why the Ford F-150 and Chevy Silverado have been top-selling models for decades.
Truck buyers, are really looking for certain things. So we made sure that we delivered every one of those why buys for a truck, and then everything that Jeep is known for, we put on top of that. So we're going to give you everything you want and more. We're going to give you the open-air freedom that only Jeep can give you.
Jeep's Gladiator rolls into showrooms next year, and while few are predicting it will be a serious threat to the established pickup brands, there is no doubt Jeep is looking to shake up the truck world. Phil LeBeau, Nightly Business Report, Los Angeles.
Finally tonight, the Fearless Girl statue is no longer staring down the Wall Street Bull. The sculpture was moved last night. It will be reinstalled in front of the New York Stock Exchange by the end of the year. And in its place is an outline of the footprints where the statue once stood. State Street, which sponsored the Fearless Girl, left the marker there so visitors can stand in her place. And obviously, plenty of people already are. Before we go, let's take a final look at the day on Wall Street. Powerful rally, the Dow advancing 617 points, the NASDAQ up 208, and the S&P 500 up 61. That is the Nightly Business Report for tonight. I'm Bill Griffith. Thank you so much for watching. And we want to remind you that this is the time of year that your public television station does seek your support, and we do appreciate that support. Have a great evening. See you tomorrow.